Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest high energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Also, I just want to thank everybody who takes the time to like and subscribe to this channel. These two things really do help us out very much, and I love answering everyone's comments as well. Let's break this down today, ladies and gentlemen. Something massive is happening in the crypto world right now, and very few people see it coming. XRP, Bitcoin, and other major assets just received signals from global power structures that could completely change the landscape. But this isn't just about crypto. It's about money, jobs, and the rules of the road that shape entire industries. Today, we're going to break it down, so stay with me. I want to talk about the Clarity Act updates and regulatory framework. The Clarity Act is moving forward here in the United States. We're getting another update on what's happening and what to expect in the coming months. We'll cover job creation if the Clarity Act passes, current market trends. Are we in a bear market or heading towards a bull market? Well, ladies and gentlemen, first I want to talk about consumer protection, and I think that goal has been met with ongoing discussions. But equally important is allowing the crypto industry to grow as times change. Millions of Americans are now involved in crypto. The crypto industry itself wants regulation, says a senior legislator, and a lot of people as well on the Hill. They want to attract pension plans, banks, and institutional investment. But right now, it's like the Wild West. We've worked for months to create a framework that protects consumers and allows growth. Senator Cory Booker, chief negotiator on the Democrat side and head of the relevant subcommittee, has made significant progress. While not fully bipartisan yet, the bill has been changed substantially, and further improvements are expected in upcoming steps. Why crypto legislation matters. Ladies and gentlemen, crypto legislation isn't just about investment. It's about companies knowing what they can and can't do. Banks and financial institutions understanding how they can integrate crypto safely. Creating clear rules of the road. Follow the law and you're fine. Step outside and there are consequences. Once clarity is established, investment flows naturally and innovation accelerates. If you ask industry leaders like Brad Garlinghouse or Coinbase's Brian Armstrong, they'll tell you the same. They want certainty and clear rules, not ambiguity. Paul Atkins on regulatory harmonization. Paul Atkins, head of the SEC, recently explained the approach to stablecoins and crypto jurisdiction. Stablecoins are being placed squarely in the banking sector, and taxonomy is being developed. Digital commodities versus tokenized securities. This is one of the rare times a regulatory agency voluntarily clarifies jurisdiction for another agency. Our goal is to harmonize rules between the SEC and the CFTC so innovators can operate in the U.S., not offshore. It's best for investors, financial markets, and innovators. Historically, lack of coordination between agencies has slowed innovation and created uncertainty. I want you to think of the 1929 stock market crash, where regulatory gaps allowed massive speculation to spiral out of control. Harmonization prevents history from repeating itself. I want to talk about Bitcoin, XRP, and panic. But before I do, I want you to understand something. What we're going over right now, when we get to the rand part, the Italian ice candy section, I'm going to tie in why this is all very important. So if you made it this far, I'd appreciate a like. Ladies and gentlemen, Bitcoin shows extreme weakness right now. Its relative strength index is 17, weaker than many years, including the 2022 sell-off. Many point to technical support levels in the high 50s as a next major step, but content is clear. Bitcoin is trading in line with broader risky assets. The IGV software index is down 21%, and many software stocks are down 30 to 40%. Panic is real. Bitcoin dropped to 60K but recovered to 69K. Retail traders felt the fear. Some missed XRP at $1.10. Comment right here. Did you buy the dip at 110, 112, 115, or did you let that go by? I'd love to hear. This isn't the first time markets have seen irrational swings. Remember, in history, Tulip Mania, 1637, sits mania overtaking irrationality. The South Sea Bubble, 1720, market exuberance followed by collapse. Dot-com bubble, 2000, tech adoption, panic, and eventual innovation. Survival crypto cycles mirror history, ladies and gentlemen. Fear, overreaction, and slow recovery. I want to talk about jobs and crypto industry growth. The blockchain industry is poised for massive job creation. Some highlights: U.S. employs 38% of the global crypto workforce. 68,000 crypto-related jobs. 2025 added 66,494 new global roles, 47% rebound from 2024. According to Oxford Economic Study, job multiplier of 6.2. Each crypto job creates an additional 5.2 jobs indirectly. Here are some historical parallels. Railroad expansion. 19th century U.S. Direct jobs in rail construction multiplied in supporting industries. I want to talk about Bretton Woods system post 1944. Monetary system changes created broad economic impacts similar to tokenization potential today. They forecast blockchain jobs could reach 1.5 million globally by 2030. It's massive. These will likely be high-paying roles, meaning higher tax revenue and economic growth. Let's talk about the institutional investment and winter cycle. Bitwise CEO Matt Hugin highlights assets without ETFs. Many suffered 60 to 7% declines, while Bitcoin and Ethereum were propped up by institutional inflows. Crypto retail entered a full-blown winter in January 2025. Average crypto winters last 13 months. We may be approaching the end of this winter cycle. Think about this, the gold standard and post-World War I monetary adjustment, periods of instability followed by market recalibration and long-term growth. Retail investors who survived past cycles often benefit the most in the next bull run. Let's talk about the Ondo Summit and regulation timing. Patrick Witt hinted at potential signing of the Clarity Act possibly early April. Charles Hutchinson added insight. Everyone entered 2025 expecting a magic boost from government support, but sometimes intervention can be heavy-handed, like the 2008 financial crisis, where emergency measures saved the system but temporarily distorted normal cycles. Let's talk about the Binance flash crash and lessons learned. October 10th, Binance flash crash caused $28 billion in auto deleveraging losses. CZ responded, Bitcoin itself is a $2 trillion market. You need hundreds of billions to move it intentionally. Systems can fail under unprecedented volume. And when that happens, losses occur naturally, not necessarily due to malice. Again, let's talk about some historical analogies. The tulip mania and the South Sea bubble. Sudden system stresses cause massive panic and liquidation. The dot-com bubble, again, tech infrastructure failure plus investor panic. The lessons, markets are fragile under extreme activity, but innovation persists. I want to talk about tokenization versus stablecoins. Tokenization is at a critical juncture. Stablecoins like Tether USDC, provided adoption, works at scale. Tokenization of real-world assets is still early. There's no clear playbook. Experimentation, some successes and some failures. Think of the railroad, telegraph, internet, and infrastructure. Early adopters experimented heavily, and lessons from failures shaped long-term successes. Companies like Ripple are helping guiding participants through this new frontier. I want to talk about the gold versus Bitcoin narrative. Bitcoin's digital gold narrative is challenged. Gold has outperformed Bitcoin recently as a hedge against instability. Bitcoin is a narrative-driven asset. Losing the story can cause panic. Think about the gold standard in Bretton Woods. Its tangible assets often regain trust during monetary uncertainty. So I want to hear from you. Well, ladies and gentlemen, if you made it this far, I do appreciate you. It's time for the Italian Ice. I want to talk about a couple of subjects, and I'm going to tie it all into why this is really important, okay? So stay with me here. First, I want to talk about monetary power struggle. We're talking about the dollar dominance and geopolitics. The fight over global money isn't about apps or crypto hype. It's about who controls the rules of capital, who sets the agenda for the world economy. The U.S., China, and BRICS and the EU are all maneuvering for dominance right now, and digital payments have made this struggle faster and more intense than ever. The rise of digital finance, cross-border capital flows, and geopolitical tensions, the dollar's central role in global trade makes control highly strategic, okay? So the major players, the U.S., China, BRICS nations, EU, they all have different goals. The U.S. leverages the dollar and SWIFT to maintain global influence and enforce stablecoins. China builds CBDCs, alternative settlement networks, and accumulates gold to reduce dollar dependency and to be able to challenge the U.S. Treasury dollar regime. The BRICS nations seek multipolarity and regionalized financial systems to shield from foreign leverage. The EU explores a digital euro cautiously to balance influence with regulatory oversight. So when you look at this all together, China is expanding its digital yuan pilot programs and alternative settlement rails. The U.S. continues pushing stablecoins as a global dollar proxy. BRICS continues publicity, advocating for multipolar financial structures. What are the risks to this? The U.S. exposure to regulatory backlash and technology vulnerabilities in stablecoins. China's digital yuan adoption hurdles in foreign trade. Fragmentation risks slowing down global commerce and creating inefficiencies. So this isn't about technology. It's about control over money, payment systems, and global influences. The U.S. defends dollar dominance and sanction power. China and BRICS push for sovereignty and multipolarity. Digital currencies are strategic levers in the global reset. Cause equals effect. The dollar and SWIFT dominance gives the U.S. leverage. Emerging powers deployed CBDCs to secure sovereignty and mitigate foreign influence. Digital finance accelerates cross-border flows, intensifying the battle for control. EU experiments with a digital euro cautiously. This is a modern fight for monetary authority accelerated by technology, not innovation alone. Reserve allocations and cross-border investment risk. So who controls the rails controls the world. And that's exactly what this fight is about. Why this matters, you might be asking? Understanding the struggle is essential for positioning, capital hedging, and anticipating global policy shifts. I want to talk about the stablecoins equals dollar expansions. Okay, this is really, really important right now. Stablecoins aren't just a fintech trend. They're a quiet engine of U.S. global influence, embedding the dollar into economies worldwide without formal adoption. Think about this. Historically, dollarization occurred through trade and debt. New stablecoins accelerated digitally, making influence instantaneous. Demand for fast cross-border payments and U.S. desire to project monetary influence without issuing a formal CBDC is the most important thing here. The U.S. companies, Circle, Tether, U.S. regulators, SEC, FinCEN, China, Russia, and BRICS nations, all the major players here. And what each is doing about this? Well, each has different goals. The U.S. uses stablecoins to extend dollar reach and maintain global leverage. China and the BRICS restrict foreign stablecoins to defend domestic currencies. Investors and market participants, well, they seek liquidity, speed, and cross-border convenience. So when you look at recent events, U.S. regulators are debating new rules for stablecoins. China's banning most foreign stablecoins domestically, and this is the big part right here, Ken. Global adoption of USDC continues across exchanges and platforms. There's a lot of risks and vulnerabilities about this. The regulatory clampdowns could limit stablecoin global reach. In crypto could spill over to dollar-denominated stablecoins. Stablecoins are the digital extension of U.S. dollar dominance. Okay, that's very important. When you think about stablecoins, they embed the dollar into foreign retail markets quietly. They increase global demand for dollars, extend U.S. influence via private sector issuance. So when you look at a cause-effect summary here, coins circulating internationally reinforce dollar influence. China and BRICS restrict them to preserve sovereignty. What looks like fintech innovation is actually a tool of monetary power projection. So the implications for the market, stablecoin regulations and adoption directly affect dollar liquidity, cross-border capital flows, and emerging market currency stability. So when you look at it like this, I want you to think about this, right? Stablecoins are soft power disguised as innovation. It's very important because China doesn't want stablecoins in their backyard. Not at all. They're trying to regulate and push that away. They don't want that at all. Why this matters, you're asking? Investors and policymakers must see stablecoins as strategic tools, not mere payment tech. So let's talk about CBDCs equals sovereign defense. This is really important. CBDCs are emerging nations' answer to foreign influence, digital money designed to protect sovereignty, track capital, and block foreign penetration. Central banks have long used capital control. CBDCs are the digital evolution of these traditional tools. The threat of foreign currency penetration and dollar dominance is why this has happened. So China, Russia, India, Brazil, the BRICS nations, what they're doing and what are their goals? Well, it's simple. China deploys digital yuan to control domestic flows and reduce foreign dependency. Russia uses the digital ruble to bypass SWIFT and maintain financial sovereignty. India and Brazil, well, they pilot CBDCs to modernize payments and maintain oversight. And if you look at this overall, the BRICS overall, they protect sovereignty, limit U.S. influence, and strengthen domestic policy control, okay? So China expands their digital yuan trials in retail and cross-border trades. That's the big thing to take away from this. Russia is bypassing SWIFT with PFS networks. India and Brazil advanced pilot programs for controlled CBDC adoption. So if you look at this, tech adoption hurdles and public trust challenges of what they're facing, internationally, interoperability issues could slow global CBDC effectiveness. So if you think about this, CBDCs protect domestic economies from foreign influence, okay? They lock money inside domestic systems. They maintain policy oversight and capital controls. They block retail-level de-dollarization. So retail foreign currency circulation threatens monetary control. CBDCs enforce capital oversight. They protect domestic markets and provide multipolar financial alternatives. These digital currencies are sovereign shields disguised as payment tools. Again, so what are the implications for the markets? You're probably asking. CBDC adoption influences cross-border trade, foreign investment flows, and risks for multinational corporates. If you want my opinion, CBDCs are the frontline defense against indirect foreign control. And why this is so important, understanding CBDCs is crucial for investors and policymakers seeking to navigate emerging market exposure and global payments. So when you look at this, again, the payment rails, they're the real battlefield, ladies and gentlemen. This is where it's happening. You don't hear much about this, but China doesn't want stablecoins in their backyard. So you got what the West is doing right now, not in my backyard, and the BRICS and the East side, they're doing their own version of not in my backyard, okay? The real fight really is infrastructure. Who controls how money moves matter than which currency is being printed. Is it SWIFT, CHIPS, FedWire versus CIPS, SPFS, and regional BRICS networks? This is leverage in action. So if you think about in 2008, centralized financial rails magnified systematic risk. Control over transaction networks has always been a source of power. When you think about the concentration of financial power in global rails and exposure to sanctions, major players like the US, China, Russia, and BRICS nations, well, each has their own goals and they're going about it differently. The US, they maintain SWIFT and Fedwire dominance to enforce sanctions and protect global influence. China, Russia, and BRICS, well, they're building alternative rails to bypass US control and preserve cross-border autonomy. Regional banks and participants, well, they have their own take on this. So they're expanding network connectivity while minimizing exposure to dominant rails. So if you look at recent events and tactical moves, CIPS expansion by China for cross-border settlements, SPFS adoption by Russia to circumvent SWIFT, BRICS working on alternative trade networks. There's some risk to vulnerabilities on everyone what they're doing right now. Fragmentation could slow international transactions. Dominant rail disruptions could cause systematic shocks. So if you think about this, right, to sum this up, control over settlement is what we're talking about. Infrastructure determines global financial power. So think about this. U.S. dominates SWIFT and dollar clearing. Other nations are build alternative rail networks. They don't want to be pushed around. Fragmentation reshapes global power dynamics. So here's a cause and effect for you, the way I look at this. Because U.S. rail dominance allows power projection and sanction enforcement. China, Russia, and BRICS build alternatives. Whoever controls these rails controls liquidity, influence, and leverage. These rail fragmentations affect trade settlement, currency risk, and cross-border investment strategies. I look at it like this. Without rail control, currency dominance is meaningless. Why this is super important, you need to pay attention to this, and none of this is financial advice. This is my opinion. Payment rails are the backbone of financial power. Knowing who controls them is critical for strategy and risk management. Again, let's talk about gold is the strategic anchor. While digital currencies and rails battle for supremacy, gold quietly reasserts itself as a politically neutral safe haven asset. Central banks, private investors, and nations are accumulating. Gold has historically acted as a hedge against currency crises and geopolitical uncertainty from Bretton Woods to modern reserve accumulations. Monetary uncertainty, currency fragmentation, and sanctions exposure. The major players here, China, Russia, India, global retail investors. What each is doing is got what's better for themselves. Central banks, China, Russia, and India, they accumulate gold to hedge against currency risks and reinforce reserves. The retail investor, well, they buy physical gold to preserve wealth. Governments and policymakers, they use gold as a politically neutral anchor. Recent events and tactical moves increased reserves to 74.19 million ounces in January 2026. Retail demand for coins and bars up 35% in 2025. The risks and vulnerabilities you're asking, price volatility from speculation on geopolitical shocks, storage, liquidity, and the movement constraints. So when you think about gold right now in this whole structure, gold is a neutral, recession-resistant monetary asset. I want you to remember this. Central banks strategically accumulate gold. Physical demand by investors rise. Gold operates outside digital political control. So in a cause and effect situation, the way that we look at this as financial mercenaries, monetary uncertainty and fragmented rails push central banks and investors to gold always. Gold remains politically neutral and sanction resistant, providing stability when digital currencies are constrained. Ladies and gentlemen, gold influences reserves always. Hedging strategies and portfolio diversification for institutional and retail investors is very important. This is not financial advice or opinion. So gold anchors value when digital and political systems are fractured. This is so important because gold is no longer just a commodity, ladies and gentlemen. It's a strategic tool for wealth preservation and risk mitigation. I want to thank everybody who has joined the Patreon. I love chatting with everyone and all the new members of our membership channel. You want to learn how we turn this into actionable intelligence to help you. Please come and do join. It's so amazing helping people take advantage of really what they want to do. I'm going to summarize what I just went through very, very fast so you can understand. We have chaos going through domestically here right now, trying to get bills passed, right? We're in the camp that any form of clarity is better than no clarity. The chaos that I just tried to take the PhD out of PhD, and I'm hoping that you have the Gucci clarity and conviction. If you made it to this point, I really appreciate you. Please give me a like. There's chaos overseas on the east side. The BRICS in China don't want any form of stablecoin there. They view stablecoins as nothing more than a same present in a different wrappered box, U.S. control. And they don't want it there. The same way that we went over in a video that India did not want stable coins. They thought stable coins was a threat to their own economy. They like CBDCs. It's crazy how their narrative is. But they're not really going over this in legacy media. This is very, really, really important. This is geoeconomic warfare. As a financial mercenary, these chaos situations allows us to do things, right? That term was given to me because on the floor of the Mercantile Exchange, depending on what type of seat you had, what kind of pit you can go into trade. I went into and traded every pit, and I was very lucky that I got and clerked and worked for some of the best locals in each pit. So I learned their tactics and trades of what to take advantage of, which I love sharing with everybody in our Patreon. Why, as a financial mercenary, I quite don't really care what happens. I care about my bank account and the people that retain us, our bank account growing. That's why do not get cut up like sushi here. Again, do not get cut up like sushi here. Everything is trading right now very institutional. Institutional is boring. They're buying. Don't be selling. Stay with me here right now, okay? Someone asked me over the weekend, I'm sorry I couldn't be here for videos. No, I don't watch the Super Bowl. I worry about financial events. Over the weekend, what I was paying attention to, I was paying attention to at least 100 C-17 aircraft headed to the Middle East and what that could mean for gold, oil, everything. As you listen more with us, you begin to realize as a financial mercenary in this soap opera of chaos right now, current events gives us a way to formulate alpha. But someone asked me why I love cryptos, and this is very important. And this was a similar reason of why, at a point in my career, myself and other investment bankers went straight into physical commodity concession developments. This is really important, and why, at least from my perspective, okay? I want to talk about investor ownership. Ladies and gentlemen, and this is my opinion, this is not financial advice. When most Americans buy stocks, bonds, or ETFs, they think they own them. But in reality, they hold claims, not legal title. And this distinction matters when markets stress, okay? Direct ownership used to be clear. Physical certificates, registered to investors, modern market centralized ownership through the DTC systems, modern brokerage centralization in the depository trust company, DTC nominee system. The major players here were investors, brokers, DTC regulators. Each had different goals. Investors receive economic benefits but lack legal title. Brokers manage portfolio securities, many pledged assets for financing. Regulators set rules, Article 8, SIPC, but did not guarantee full legal ownership in crises. I want you to think about the Lehman Brothers, 2008, Man Financial Global, 2011. I remember Man Financial when I first saw them in Building 7, before they grew into a Goliath. It's so funny, the same way I remember SHB, the people who taught me how to trade heating oil in the heating oil pit. I remember the names of all and the colors of their trading jackets before they traded and traded up to become much bigger or got in some form of, let's just say, catastrophe that led to some heartache or just really bad things. I remember learning from all these people when the world was a much quieter place. But I want you to understand something, right? I want you also to think about Sentinel Management 2007. They highlighted risks when claims are subordinated. So broker insolvency can delay recovery of subvert claims. SIPC protects against isolated failures, not systematic ones. I want you to think about this. Economic exposure is not the same as legal ownership, okay? Legal title resides upstream at the DTC. Claims can be subordinated during broker crisis. It's very important. Investors must understand the distinction to protect their wealth. I want to talk about some cause and effects of this. Modern centralization pools, securities at DTC, investors receive benefits, but legal control remains upstream. In crises, this distinction can determine speed of recovery or total loss. So what this means for the market, investment liquidity and risk profiles are affected during systematic stress. Understanding ownership structures is critical for portfolio safety, okay? Ladies and gentlemen, most investors don't own what they think they own, sadly. They hold a claim, not a title. Why this really matters? Recognizing the gap between legal title and claims allows investors to manage risk, diversifying custody, and plan for crises. This is so important. It really, really is. Global financial system is splitting. No single currency dominates entirely. We're moving toward regional currencies, separate rails, and multipolar trade systems. Post Bretton Woods, the U.S. dollar-denominated emerging markets relied on regional reserves, but digital finance and geopolitical friction now accelerate fragmentation. I want to talk about the causes and players. Causes, stablecoins, CBDCs, and geopolitical tension and digital payments. The major players here, U.S., China, BRICS, EU, central banks globally. What each player is doing and their goals? Well, the U.S. maintains dollar for international trade and leverage. China and the BRICS develop regional settlement networks and CBDCs, explore digital euro cautiously to protect influence, tactical moves, and recent events. China pushes digital yuan and alternative rails. The BRICS establish gold-linked and regional settlement mechanisms. The U.S. promotes stablecoins for cross-border influence. I want to talk about the risks and vulnerabilities. Fragmentation could reduce liquidity and complicate trade. Conflicting many systems may create geopolitical tension or instability. Global finance is splitting into regional multipolar systems. The dollar dominates part of the world, RMB dominates another. Multipolar systems reduce U.S. leverage. Stablecoin, CBDCs, and gold-anchored regional strategies. Dollar and stablecoin push, U.S. influence, CBDCs, and regional rails push back. Gold and alternative networks anchor emerging. We are entering a split global economy where no single system rules all. The implications: investors must consider regional risk, currency exposure, and hedging strategies across multiple financial systems. Multipolarity and dollar hegemony cannot exist together indefinitely. So why this matters? Understanding this helps investors anticipate currency risk, manage cross-border exposure, and position for the future of global finance. If you made it here, I appreciate you. As the world splits into camps, like we said, the east and west side of the tranche, it's regionalism now. It's the end of globalization, regionalism. The BRICS and China want it their way. They don't want stable coins there. The West wants it our way. So the argument inside of Congress is seriously important, yet nobody's paying attention because it's this hard to grasp. You have people arguing over whether or not coding and all kinds of certain things. I guess they have their perspective and their point of view, but as the remora and a financial mercenary, we look to take advantage of all the chaos happening right now. And there's so many plays right now in the chaos world and the pestilence world to create alpha. It's unbelievable. But all you have to take, and I'm taking the PhD out of the PhD with this, is that the world is splitting into two camps, like we put up our maps, okay? Stable coins are no bueno on the east side of the tranche. India looks at them as a threat. China looks at them as a threat. They look at it as U.S. meddling in their affairs with treasuries, which stable coins are nothing but a wrapper for there. They think CBDCs are better for them, yet Iran continues to buy copious amounts of Tether. So go figure that, right? But this is the most important thing to pay attention to. Everybody has their own goals and reasons of why they're doing this, again. Okay. Well, today I see China signaling to investors to reduce their U.S. Treasury holdings, and the market is starting to interpret it as more than routine risk management. Goldman Sachs is highlighting that gold and silver are leading a real-world asset rotation, with oil likely to follow. From our perspective, again, this is not financial advice. This is a clear rotation driven by capital flows rather than purely by fundamentals. If you look at the Shanghai COMEX, the silver spread or basis, it's coming back into more reality, which is a good thing, and it's stabilizing. That's a very, very good thing. Geopolitically, silver continues to act as the canary in the coal mine. China is being squeezed out of U.S. influence, and the growing assertiveness, particularly on Taiwan. It's something that we've been tracking very closely. But if you look at silver's movements, they're increasingly reflecting these structural tensions in global markets. So if you look at U.S. Treasuries, Chinese regulators are advising major banks to reduce exposure due to concentration and volatility risk. While this excludes state reserves and avoids overt geopolitical framing, it signals a broader diversification trend. From our perspective, this is less about immediate selling and more about demonstrating market influence. Even a small move, 3 to 4 or 5 basis points in yield, is enough to get the market's attention, which underscores the power of signaling in today's interconnected financial environment. Gold and silver are leading the commodity rotation, according to Goldman Sachs. Smaller, less elastic markets like metals are reacting faster to investor positioning. Oil appears next in the line as capital flows expand across real assets. Each commodity has its own upward catalyst. Gold is being monetized. Silver remains tight. Copper is constrained by its demand for everything electric these days. But the broader trend is clear. Real assets are back in favor. Okay, why I went over that talking about real assets. If you control the keys to your crypto, you have it. You physically have it. Physical concession development, we have what's in the ground and what we're pulling out of the ground in our storage sheds and whatever. We owned it. That's something that was drilled into my head by some of the most powerful people on the floor of the American governors and COMEX, of just a lot of things that just drilled it into my head. Amazing, right? So I look at what's happening right now in the world and what I just said before about at least 100 C-17s are headed to the Middle East. If oil continues to push higher, it could have a very, very good, setup. But I've seen too many horror stories back and forth with this, because this is being driven by news narratives. Again, it's something to pay attention. Why I say being a financial mercenary, you go from theme to theme to theme to theme. That's most important. Again, okay, ladies and gentlemen. AI technology, even crypto, a lot of it has lost its allure. While I always say that as a trader or a prop desk or a fund manager, you got to make your weekly numbers, your monthly numbers, your quarterly numbers. It's easy to do this right now in the commodity play because the geopolitical news influences an easier path. The accumulation on an institutional level inside of the crypto space is massive right now. I think retail has been cut up like sushi, and they've lost their Gucci clarity. They've lost their conviction. They don't want to be in it anymore. But this is why when you get involved in infrastructure, it is a very long, cold march off that frosty mountain where you have to have your frosty beverage. It does not happen overnight, but you can see the way the world is going. We're in the camp that we believe clarity and legislation gets done and sticks, because it has to be. There's so many people arguing and pulling you can see where real motivations lie. But being the remora, we swim underneath the shark and we feast on what it does. And it's feasting on so many things right now. A lot of people had wished for certain levels to have a chance again at that. Those levels are showing. So there's a lot happening right now. And if it makes sense to you and your personal situation, and this is what you wanted to be at, it's a good thing, in our opinion. Sum this up. I saw a lot of chaos in the fall of the mercantile exchange growing up. I saw a lot of the clearinghouses get hurt, closed down in scandals. And I got to learn from a lot of the owners of the clearinghouses what they were. I got to learn a lot of things from these men and women. I learned the tricks of each market from them. The one thing I learned most from all of them is the Gucci clarity and conviction to understand why I'm in this, to follow my recce, to follow my plan, to follow my goals that I've written out, to understand where we're going and why. This video was probably too much PhD, and I'll get it better working on what we're looking at. But the main things all you have to understand is, look, the East has made their move. There are things in play right now. I learned to take advantage of pestilence, war, chaos on every level growing up on that mercantile exchange. The crude oil pit has a special place in my heart, and in our Patreon premium section, I'm going to tell a story of why that for a week I had to sit in that pit by myself getting hit in the head in cards, which was torture. And when things begin to move, pay attention to what's quiet. If you're paying attention to what's quiet, you're so far ahead of the game. That's all you got to do. I need you to think about the very people who shaped the global financial system have had their eyes on XRP from the very start. They debated it. They tried to control it. They tried to slow it down. And yet here we are. This isn't hype. This isn't theory. It's documented influence at the highest levels. And here's the craziest part. While retail investors panic, all the leverage is gone. Metals are quietly stabilizing, and XRP is holding its structure. You're watching history unfold. You're seeing a rare moment where everything aligns quietly. The system, the assets, the players behind the scenes. If you're still here, still paying attention, still thinking instead of reacting, you're already ahead of most people. Years from now, this period won't be remembered for panic. It'll be remembered as preparation. Stay patient, stay grounded, and above all, pay attention to what's quiet. Markets don't do this by accident. That's not noise, that's structure. You're a part of it. You're witnessing it. And you'll look back one day and you know you understood what's most missed. Thank you for being here. I appreciate every one of you. This content's for informational and entertainment purposes only. It should not be taken as financial advice. Always do your own research and consult a licensed financial advisor. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves to never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues to develop behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, to accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opens your eyes. Smash the like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, and stay in the Republic. Love you all.